You're with us here on a fresh new edition of Bazaar Morning Call. I am Prashant, with me, my colleague Sonia and Nigel. Guys, hi. Good morning. It's a Friday, so faces are up, chins are up.
The biggest cue of the day.
All right, we've got the day to get by though, so let's get this started. You've got basically more of the same in terms of US markets, which were down. The S&P was lower. You've got the Nasdaq, which was down by about 1%, 1.75%. So tech is clearly under more pressure. Value still relatively did a little better. The dollar is on the rise once again. So the dollar index hit 113. And right now it's at about 112.78, a little better as compared to where we were at New York time. But, I mean, worse off as compared to yesterday. And the SGX Nifty, well, it continues to be in a completely different space. And we're up about 15, 16 odd points. Flat kind of start is what we have. The question is, you know, the resilience and the outperformance has been there as a constant feature all this year. Will this continue to power our markets up even as the rest of the world starts to suffer once again? The rally in the US, the 10% rally, is more or less done. But what about here? Guys, good morning.
Hi, morning Prashant, morning Nigel. Morning. And in that context, our own markets were quite resilient, right? Yesterday, I mean, 18,000 was holding firm amidst all the volatility. This morning may look a bit different because Wall Street has extended its losses, and it's now 4 straight days that the US markets have been under pressure. It was a steep cut yesterday as well. And give and take everything for the week too, you know, the S&P 500 is down almost 5% this week. The Nasdaq is down about 7%. Later in the evening, you have the US jobs report that comes out, and that cue is crucial to understand about the pace of future rate hikes. So the October jobs report is expected to come in at about 205,000 jobs. The unemployment rate is expected to be steady at 3.5%. In anticipation of that data, perhaps our markets could be in pause mode because we also have the weekend and there are SBI's numbers tomorrow. SBI's numbers could be a big cue for the PSU banking space, which has done very well. So a lot of cues stacked up, and in that context, perhaps the Nifty may pause around this 18,000 mark. We are still just a smidge away from that, 18,352 week high. But for now, the SGX Nifty is indicating that the start will be mildly in the green. The resilience is there, but today, because we're heading into a weekend, next week is also a truncated week, and you have some big cues coming up like SBI's numbers. Maybe, just maybe, there could be a pause.
I mean, it looks like we're going to be in a range, right? I mean, there is not too much to take this market higher, and the downside is protected because the market here has got that kind of fundamental lift, so as to speak. All right, let's just quickly run you through how things are looking. So US equity markets were down, as I said, tech more under pressure, and I think we saw that we saw similar kind of price action the last trading session in the US. Tech here sold off as well. Cognizant, of course, numbers did not help. The yield market is reacting once again. So the 2-year yield, and this is market interest rates, which are very meaningful. The 2-year, the front end of the US yield curve, is gone up. You want interest rates lower, not higher, but for now they are headed higher. The 2-year yield is at about 4.7%. The difference between the 10 minus 2, remember that, I mean, if you're paying a bond for the next 10 years, you're paying for the bond for the next 10 years, the yield that you expect, because you're taking the risk for a longer time, should be higher than something which is of a maturity of 2 years. But the 10 minus 2 is now negative, and that negative is basically called inversion, and the inversion is at a new high. It's minus 58.4, the 10 minus 2, and that basically indicates that the economy going forward is going to have a tough time. The DXY index, that's a dollar index. I mean, actually, dollar outperformed pretty much all other currencies. The dollar index was at about 112.78. On the DXY, you got a second outside bullish day, which basically is an important, significant bullish indicator. And I think what this means is that the dollar should push through higher eventually. It's not been able to do that. I mean, 117, 119 kind of targets has been talked about for a while. That's not happened, but we'll see if this comes through now. US jobs data tonight, I think always important. But, the bar for this to really move markets has gone higher because we've just heard from the US Fed chair, all of the hawkishness coming through from him. So only a very large miss in the jobs data, and that seems unlikely because we got claims data, right, which inched lower. Jobless claims data out of the US, that's high frequency indicator, which inched lower. So it would have to be a big miss to offset hawkishness that we just heard from the FOMC, the Fed chair. Nifty near-term support levels at about 17,960, which is, I think, also sort of the low that we saw yesterday. It's also the 40 exponential moving average, 40 hourly exponential moving average. The weekly averages are far below. So, I said this yesterday that eventually maybe you kind of drift down to that because the upside seems to be a little capped because of the global environment. But is at 17,540. So we'll have to take it as it comes. The swing high, recent swing high, is 18,179, beg your pardon. And that is the level to take out on the upside. That is the high that we saw in trade on the 2nd of November. So those are levels to really watch out for. It's a narrow band for now, narrow range for now. The SGX is indicating that, and we'll just kind of trade off some of these levels as we start another session. Nigel, what are you watching?
What an exhausting week, right, guys? I mean, 5 whole days of work. It was quite...
I thought somebody, Sonia, said that next week is a holiday truncated week.
Yeah. But I'll tell you the bad
Somebody
news.
would give a shout out.
That's the last one for the year. That's the last holiday, and then till December there's no holiday.
There's just 1 more month left for the year anyways.
Two, because November 1st.
And 2 more months for the year.
I'll be on leave in the last week of December.
Got the numbers and the dates all written down.
All right,
we'll take what we get, right? Holiday with the first or last will do for us.
All right. Well, yesterday the bulls took what they got, right? Yesterday was a good outperformance that we saw on the Nifty. In comparison to what the globe did, well, the bulls will be very, very happy. But some of those headwinds do persist, and we need to take note of that. This morning, the dollar index has moved to around 113 odd. And in this sort of a backdrop, I'll be interested to see what the FIs do. They have been buying the Indian markets for the last 6 trading sessions. They've been pumping in close on 2,500 crores on an average. But yesterday, in fact, you had the lowest buy inflow in comparison to the previous 5. And on average, this 5 days, we saw an average of 2,500 crores odd. So the FI flows become extremely crucial. The FIs in the F&O market, we were saying that this market is net long, which is not such a good thing. Seems they heard us. They've gone ahead and they've added some short positions, close to around 15,000 short contracts, 4 shorts added for 1 long position. This is not a bad thing. We keep saying this because in case the FI flows dry up, then the shorts in the system could give a bit of a fillip if the markets do start moving up. Long short positioning as well, continue to remain net long on the index. Now on the options data, there seems to be a bit of a trade that's playing out there. That's a short straddle. What is that? You write the 18,000 call as well as put. The same strike, the call as well as put. You pocket close to around 300 rupees because on the 18,000 call, premium is around 180, 190 rupees odd. On the put side, it's close to around 105 rupees odd. So put that together, you're pocketing close to around 300 to around 330 rupees odd. And then you're playing for a broader range. Close to around, on the downside, 17,700. On the upside, close to around 18,300. My guess is that, the buy on dips is likely to continue, but you'll require a bigger effort for the Nifty to go ahead and break that 18,300 odd mark. That's a bit of a barrier according to me. 18,250, 18,300. For starters, the SGX Nifty, well, it's indicating a more or less flattish start. Sonia, what else?
Okay, a more or less flattish start for the SGX Nifty. Today is also a big day, right, in terms of earnings. You have lots of numbers coming out. There's Britannia, there is, of course, a lot of auto companies. There's TVS Motor coming out with numbers. There's Titan, Walcott, and a long list of mid and small cap numbers. And then tomorrow on Saturday, there's Bank of Baroda, there's State Bank of India, there's Power Grid Corporation. So we have our hands full in terms of earnings. But here's what you can see in the next 2.5 hours. First up on the equities front, we have a comment coming in from Chris Wood of Jefferies, who says that the Fed tightening expectations are now at their highest since this tightening cycle began, following the Fed Reserve's universally anticipated hike in the federal funds rate to 3.75 to 4% yesterday. He says money markets now expect a peak in the federal funds rate at 5 to 5.25% by May 2023. He also says that greed and fear's guess is that this is the peak in tightening expectations, barring some Ukraine-triggered surge in energy prices.
Well, Lawrence Belanco of CLSA says that the Nifty's rally of support provided by the 200-day moving average is now testing overhead resistance, suggesting that upside momentum is slowing. He says the combination of cited resistance with slowing upside momentum is likely to result in market remaining range-bound within the 18,152 to 18,539 to 15,178 to 15,500 trading range. He says a clear break above 18,152 to 18,539 would confirm bullish implication, with such a move providing an upside objective of 20,185. On the downside, he adds, a break below the 200-day moving average would imply a deeper pullback.
Okay, let's also get you some money market views. This assumes importance given all the global, data that we're getting later this evening. Bhaskar Panda of HDFC Bank says the US yields have risen after the expected 75 basis points rate hike and the hawkish tone from the Fed, and US terminal rates are getting predicted above 5%. He says oil is down a bit and so is the dollar index this morning ahead of the US jobs data. He says markets will remain volatile and uncertain given this global backdrop. He expects the dollar INR pair to remain a bit under pressure. He expects a range of 82.60 to 82.80 for the day.
Well, on bonds, Bhaskar Panda says US rate hikes, inflation concerns in India and the MPC all play into a little higher yields today. He expects the 10-year benchmark bond yield to trade in a range of between 7.45 to 7.55% for the day. Okay, so that's views across asset classes. Michelle Kluwer is portfolio strategist at Global X ETFs, and we have Michelle joining us now. Michelle, great to have you with us here. Thank you very much. Appreciated your time on CNBC-TV18. How are things looking, Michelle, to your mind, both in terms of flows and flows towards emerging markets to begin with, in the environment that we've got out there in the US? One noticeable factor after this FOMC meet that we've had is that the rest of the globe has fared much better as compared to US equities, which sold off more. Go on.
Yeah, so certainly coming out of the Fed, there was a shift in rhetoric, shifting the focus away from the speed of rate hikes towards the level and the time that the Fed remains restrictive. And so that had a large impact on the terminal rate that markets are expecting for the Fed to get to. And so that also impacts the discount rate for US equities. And this had a large impact on the US market. There had been a large amount of focus on the potential for a shift to a slower trajectory for the December meeting, with possibility of a 50 basis point raise at that meeting. That's still potentially on the table. It's about a 50-50 between the 50 basis points and 75 basis points at that meeting. But that's still, with the increased focus on level and time that we stay at the higher rates, has shifted the narrative away from the potential of slowing. This does still leave the potential for that. Then shifting focus to emerging markets and other markets. Most of this year, we've had a bit more caution towards emerging markets, and we certainly had seen lower levels of flows into that space. But at the same time, during October, there was more interest in the area as equity markets were doing a lot better. The dollar strength has been a factor that has been impacting into the emerging market space as well. But in this current environment, obviously, there's a lot of focus on central banks, also with Bank of England this morning also raising 75 basis points. So certainly a very hawkish environment.
Got it. Michelle, good morning. So you did say that there's a 50 basis points rate hike in the December meeting by the Fed, which is still on the table, right? Do you think that has been priced in by global equities? Because this week itself, we've seen the US markets fall about 4-5%. You think most of the bad news is in the price, or could there be more to go?
It's difficult to say. Obviously, there is also the concerns about potential recession. What was the news coming out of the UK this morning was leaning more into the recession risks, while the information out of the Fed from yesterday was leaning more into the discount rate. And so both are risk factors that are putting downward prices on share prices, but at the same time, there is a large amount that's already factored into prices. The big factor to be looking at is earnings. It's been a bit mixed, where we certainly have been seeing some earnings coming in above expectations, but also some disappointments, and guidance also very critical.
Hi, Michelle. Morning. Good to speak to you. Talking about earnings, Indian markets are going to give some of the best earnings. The problem is how much of that is already in the price. Now, Chinese, that market is underperformed. Whole host of issues out there. But valuation-wise, that's attractive. Between these two, which one would you prefer at these valuations?
There's a lot of political overhang within the Chinese market at the moment,
yes,
which makes it a lot more difficult from an investment standpoint because everything comes down to a policy choice. And so within the current environment, I find that's a challenging environment to suggest, although the valuations are attractive. And because of that, I would say India's looking a little bit more attractive.
Okay, on that very optimistic note, we will thank you, Michelle, for joining in. Have a great day. And thanks for being with us on CNBC TV18. That's a global portfolio strategist saying that India is looking quite attractive given all the global uncertainties. Let's slip into a quick break. There are plenty of stocks to talk about. So without wasting any time, a quick commercial break. And our entire team will be with us in just moments from now. Stay tuned.
Welcome back. Well, the SGX 50 suggesting a flat start. Yesterday, we had a resilient performance. We came off the low point of the day and almost ended in the green. But today, there are a lot of stocks that we're going to be tracking in our top 10 segment. Sonia, you go first. Tell us about Hero MotoCorp. Numbers came late last evening.
Well, the numbers came late last evening. And you know what? Although the revenue growth was fine, it is the margin pressure that could perhaps keep a lid on the stock once again. The revenue growth was largely in line with estimates. It was about a 7.3% growth that we saw. But the EBITDA was down 2.6% at a time when a lot of, auto companies are seeing a recovery in margins because of the fall in raw material costs. Hero MotoCorp refuses to see that. The ad expenses have been higher as well for Hero. The ad spends have been higher. So that's been a drag on the operational performance too. The margins are down 110 basis points year on year, and the profits are lower than what the street was estimating and lower than what they did same time last year. The volumes, as I said, continue to be under pressure because of a slow recovery in the rural market. So total Q2 volumes were down about 0.7% at a little over 14.2 lakh units. Now, the management says that the global macro headwinds may keep the play field a bit uncertain, and navigating the same over the next few quarters will be important. However, as commodities cool off and rate cycle reaches its peak, the medium-term outlook for the Indian auto industry appears quite encouraging. So I guess cautiously optimistic there, but I'm going with red because the margins just refuse to recover for Hero MotoCorp. And we have seen, the recent sales numbers have not been impressive as well. So there is still some problems there.
Retails, especially in rural markets, have also, the wholesale numbers, have been a little better, but retails have been hurting as well. Now, Adani Enterprises is the other one which reported numbers. Vivek is here with more on this one. Vivek, hi, morning.
Well, good morning. It's a strong Q2 from Adani Enterprises. Remember, this time around, a lot more businesses what they've incubated, and the company calls itself as an incubator of businesses. So largely, when you're tracking the company, looking at how the various segments have performed. So it's been a good Q2, mainly on the back of very strong coal trading volumes and good margins coming in there as well. And also, when you're talking about these volumes, jumped up almost 70% on a year-on-year basis. When you're talking about the revenues more than doubling, again coming in close to the 38,175 crore mark. When you're talking about the margins too holding up closer to the 5% mark versus the 6.7% mark on a year-on-year basis, and profit again more than doubling at 461 crore. When you're talking about some of the key segmental highlights, number one, one of the main segments, the Adani Roads business, the Ganga Expressway achieved financial closure of over 10,200 crores, an important update there. And when you're talking about Adani Airports, remember the company managed to actually go ahead and do an operational update of close to 90% of the pre-COVID level. So again, some strong traction seen over there. However, on the other side, solar manufacturing as well as coal mining actually saw a subdued operational quarter this time around.
Okay, all right. Thanks a lot for that, Vivek. Let's hop across to Rima. Rima, how was Vodafone Idea's numbers?
Well, subdued. So the good part is they managed to see a revenue growth. So revenues have gone up by 2% on a quarter-on-quarter basis. So that's a positive. But margins have seen a big fall. Margins are down 300 basis points to 38.6%. The losses continue to mount. Loss this quarter is at 7,500 crore plus. the overall subscriber base has fallen by 6 million on a quarter-on-quarter basis, and compare this number with peers, because that's where the genesis of the problem is. Jio added more than 7 million subscribers in the quarter. Bharti Airtel added 500,000 subscribers, but at the same time, Vodafone Idea lost 6 million subscribers. Their average revenue per user went up by 2% quarter-on-quarter, 20% on a year-on-year basis. So that's a positive. But the problem is they continue to lose subscribers. Their debt is mounting. The net debt has risen well over 2 lakh crore rupees. That's putting pressure on their finance costs, as a result of which the company continues to post massive losses. The losses this quarter stand at more than 7,500 crores. Back to you.
Okay, thanks a lot for that. So that's on Vodafone Idea's losses continue over there. But I'm watching Amara Raja batteries and I'm going with a bright shade of green because it was a very good set of numbers from Amara Raja. The revenue growth came in at almost 19%, a profit growth of almost 40% year on year. But the big positive really is the margins, 140 basis points higher on the margins at 13.2%. And the company says that the demand in the automotive sector from the aftermarket as well as the OEM segment was very robust. Exports showed a healthy growth in Middle East and the Southeast Asian markets. The industry battery volumes continued their upswing, especially in the telecom segment, driven by the 5G rollout in India. And they've now announced a lithium-ion battery manufacturing subsidiary for, a move into the electric vehicle space, a larger presence there. And that's something that the street will like with both hands. The other big positive is that the margins are now back above 13% after 5 consecutive quarters. So I'm going with a deep shade of green there.
All right, thanks very much for that, Sonia. Now, Ajanta Pharma is the other one which should be in focus. Ekta is standing by with more on this one. Ekta, hi, morning.
Thanks for that. Well, yes, definitely a multi-quarter low in terms of margins for Ajanta. So that came in at around 20.9%. The street was anticipating around 25%. Now the profit was down 20% simply because of the operational miss that it reported. The Q2 revenue was in line, so it was up 6%. The street was anticipating around a 7% growth. India sales did very well. It was up 27% year on year. Asia was strong, up 30% year on year. But what really got the street was US, which was down 5%, and the Africa institutional business, which was down over 50% on a year-on-year basis. The margins this quarter were impacted by factors such as raw material, freight costs, price erosion in the US, preponement of certain costs from Q3. But what could probably show some amount of cushion and respite today is the guidance. Second half is expected to be better. So they are guiding for margins of around 26%. They expect Asia to grow around 20%, and they are bullish on the India growth as well. So that could probably cushion any kind of downside that you could see for Ajanta today.
Okay, all right, Ekta, thanks a lot for that. Well, I'm looking at a couple of numbers on JK Lakshmi Cement. Actually, those numbers look good. The top line was a little lower than what Jefferies estimated. But the good news is that the realizations were much better. And input costs didn't go up as much. And that explains why on the EBITDA front, well, the number came in much better than what the street was working with. Profitability as well did look much better because the finance costs were a little lower. The other income as well was a little higher. In addition to the good set of numbers, the company has valuation support because now it's more than a 15 million ton unit and it trades around $70 per ton. So that's good news as well. Expect the stock to open up in the green while some of its peers either met or missed estimates. Well, this one beat estimates, so good news. Rain Industries, well, the numbers look pretty good on a low base. Revenues were higher. The adjusted EBITDA number was pretty okay. And the margins were higher as well. So a green tick on both those two, Sonia.
Okay, green tick for Rain and JK Lakshmi. But let's move on and talk about Blue Star and SKF and how it shaped up. This time, Vaishta has more details for us. Vaishta, over to you.
Thank you for that, Sonia. Well, Blue Star has seen a marginal miss on the estimates. Though the revenues were up 27% on year-on-year basis, the margins have slipped to 5.4% versus 5.6%, which is just about a marginal slippage. But the poll was higher at 6%. The order book is also healthy at approximately 4,100 crores, which is up 30% on year-on-year basis. Now, within the electromechanical projects and commercial AC systems, the pace of execution remains healthy and there is a strong uptick in the inquiries. Also, in the unitary products division, the EBIT margins have improved to 6.1% versus 5.1%. Moving on to SKF India, good set of numbers coming in. Revenues were up 12%, margin have improved to 19.9% versus 16.5%, going with a green on the stock.
Okay, all right. Thanks a lot for that, Vaishta. Well, Vivek, we just got an update coming from IEX and it continues to look weak, right?
Well, that's right. It's a very subdued operational update as far as IEX is concerned. This is for the month of October. So when you're talking about the volumes at a little over 7,970 million units is down both, on a month-on-month basis and on a year-on-year basis. The management says that, the volumes are lower mainly because of the higher base and lower month-on-month volumes due to reduced renewable energy certificate trading. Also keep in mind, on the back of the price capping on the exchanges, a lot of sellers have also stayed away, is what, analysts actually tell us. When you're talking about the easing constraints as far as the coal supply is concerned, that has also led to a downtick as far as prices are concerned. And what the management is saying is that going forward, due to improved availability in winter, you will actually see prices falling further, and also volumes may be lower going ahead. So red there. Also remember, due to the onset of other power exchanges, there has been a slight dip in the market share. However, company enjoys a 95% market share as of now.
Okay, thanks a lot for that. So we'll keep tracking all of these stocks for you. But in the meantime, in case you missed out on any of them, here's a quick recap. Stocks with positive news flow. There's Adani Enterprises, Amara Raja Batteries, JK Lakshmi Cement, Rain Industries and SKF. While stocks with negative news flow, there's Hero Motocorp, Vodafone Idea, Ajanta Pharma, Blue Star and IEX. In case it's too much for you, we'll take a short break so you can digest all of this news flow. And on the other side of the break, Keki Mistry, the Vice Chairman and CEO of HDFC, will be with us to discuss their Q2 earnings performance. Also in a bit, Devin Choksi of KR Choksi will be with us for some stock talk. Good morning once again. Well, the SGX Nifty for now is indicating a pause, perhaps an early morning trade. No surprises there because the US markets have been down for 4 straight days. And give and take everything, the week has been quite, bad for the bulls. The S&P 500 is down almost 5% this week. This morning, the Asian markets are also under a bit of pressure. But let's see, Nikkei is down almost, I think, 500 points or so. The Japanese market was shut for trade yesterday, so do keep an eye out on that. But moving on. India's largest mortgage lender, HDFC, has beaten street estimates in the second quarter, also reported best asset quality in the last 11 quarters. So that's a big cue to watch. Abhishek Kothari, my colleague, caught up with Keki Mistry, the Vice Chairman and CEO of HDFC, and began by asking him about the quarter gone by and his outlook on the operational performance. Take a look.
All right, so first of all, the growth momentum, which we've been seeing now for nearly 7 or 8 quarters, has continued unabated. We had the highest individual AUM growth during this period. Our individual AUM grew by 20% on a very large base, which is the highest growth we have seen in the last 8 years. And the momentum is strong, continues to remain strong. The feel-good factor in the economy is very high at the moment, and we are seeing growth coming both from the metros, the Mumbais, the Delhis, the Bangalores, the Punes, but we are also seeing equally strong growth coming from the Tier 2 and the Tier 3 towns. As far as asset quality issues are concerned, during that COVID period, there was some impact on asset quality for the entire financial sector. But I think the last few months, the economic growth in India, the feel-good factor in India is so strong. There have been hardly any job losses. People have got back there. Companies have started paying salary increases and stuff like that. So the feel-good factor is very strong. And therefore, the collection efficiency that we've seen on individual loans throughout the quarter has been well over 99%. And it's even higher in some periods compared to what it used to be pre-COVID. So collection efficiency is strong. Asset quality is improving quarter after quarter. Our total stage 2 plus stage 3 loans has come down consistently every quarter. Our credit costs have also started coming down quarter after quarter. And if you were to look at the gross non-performing loan number, that has also come down under the new method, under the RBI new method of calculation. It is now 91 basis points for individual loans, and under the old method, it is 73 basis points of non-performing loans.
Well, sir, we are in a rising interest rate scenario. As per you, how much of rate hike can be absorbed by customers without impacting both the loan growth as well as the asset quality?
See, over the years, if I was to look back at the last 15 years or more, interest rates in India have gone up and interest rates have come down. You take the example of 2008-9, take the example of 2013, 2018, and many, many points of time in history when rates have gone up very sharply. Our experience is that whilst there is obviously some impact on consumer sentiment when rates go up, it does not have that significant an impact on demand. For the simple reason that a housing loan is a 15-year loan, even though the duration is shorter. And because it's a 15-year loan and customers only get floating rate loan products, it really does not make so much difference where interest rates are at the point of time when you take a loan. Because if you take a loan when rates are low, they will become higher. If you take a loan when rates are high, they will come lower. So therefore, it has a much greater impact on short-term loans like a personal loan or a consumer loan or something like that, but a much lesser, a much more muted impact on demand for housing loans. So housing loan demand continues to remain strong, and historically we've seen periods of time when interest rates on housing loans have been 9% or even a little higher than 9%. So I would expect the growth momentum to continue.
Well, so one of the segments that is seeing growth across many other players is the loan against property as well as the lease rental discounting. What is your view on the same with respect to how are you seeing the industry trend or, the trend that is happening in your portfolio?
So consistently over the last several years, we have always said that we do our loans against properties much more slowly than what our growth in the loan against property segment is a lot lower than our growth on individual business. So we've never really focused in a very big way on loans against properties. LAP loans, as we call them, would typically be about 4% of our lending. So it's not a very large component. Lease rental discounting is a strong component of our lending. Lease rental discounting historically has been in the vicinity of between 6 to 7% of our total loan book. As the book keeps expanding, even the lease rental discounting loans keep expanding.
Another segment that I want to touch upon is the self-employed category. Are you witnessing any competition over there with dominant players in those particular geographies or those particular markets?
So let me tell you, competition is always there. Competition has been there for years and will continue to be there for years. But the fact of the matter is that all the competitors in the market, everyone in the market, sees that the growth opportunities are huge, and therefore no one needs to do anything which is irrational or anything which will be disruptive to the market as a whole. And that is reflected in the fact that we have consistently grown at a pace which is faster than the pace at which the market has grown. So, for example, if we look at this September period, our individual home loans on an AUM basis grew 20%, whereas housing loans in the banking system, if I recall right, grew by about 16%. So we grew at a rate which is about 3.5% to 4% faster than the banks. And if you track this for the last 8 quarters, you will see that consistently we have grown at a rate which is anything between 1% to 4% higher than the rate at which the system has grown.
So what is the outlook on demand and loan growth ahead for your company as well, the demand in housing finance sector, and how do you see the growth ahead for yourself?
So I think the structural demand for housing in India will always remain strong. We are a young population. More and more people are getting to an age where they will need a house. So it's a necessity. It's a need. It's not just an investment people make. So penetration levels are low, young population, affordability is still very good. So all these factors will contribute to growth. So I would expect that the growth momentum will sustain, will continue in the coming quarters. And as I mentioned earlier, if you look at the last 7 or 8 quarters, you will see consistently that we have grown at a pace which is faster than the growth of housing loans in the system. And I would expect that momentum that improvement or that increase in market share will continue unabated.
All right, that's the management of HDFC. Then Mr. Mistry, not mincing his words, they're sounding reasonably optimistic, actually. Well, Devin Chauksy of KR Chauksy joins in. Hi, Devin. Good morning. It's a Friday morning. Well, let's talk about a couple of numbers there. HDFC, we just heard out the management. What's your view on the stock?
Hi, Nigel. Good morning. Well, I think the fundamentals of housing finance business remain absolutely convincing and very, very strong. So there is no second thought on this particular subject. If you probably look at, I think, the numbers which came up from even smaller companies compared to HDFC like Bajaj Finance, Bajaj Housing Finance, I think there also, I think one has seen a very sharp growth in the disbursement as well as, I think, the new loan book that they have created. Similarly, the situation for a larger company like HDFC, I think where you are seeing on a consistent basis higher amount of, I think, the loan growth as far as, I think, the retail loan particularly is concerned, I think, which is remaining about 20%. So in my viewpoint, I think as long as we see the compounding story continuing for 20% rate of growth and above that, as far as I think housing loan demand is concerned and the disbursement is concerned, I would think that I think this particular segment would probably reward investors in a systematically steady manner over next 3 to 5 years. So from that perspective, I think the looking at company like HDFC, which is eventually becoming even more stronger once it merges with HDFC Bank, I would think that I think the size of the balance sheet would probably expand and expand much systematically and faster going forward.
Okay. Devin, hi, good morning. The other stock I wanted to check with you was Amara Raja Batteries. It had actually fallen off the investors' radar for a bit, but now it's coming back. Very good number, strong margins. The company is, putting up a lithium-ion manufacturing subsidiary as well. Is this a stock to buy now?
Yes, Sonia, good morning. You are right. I think in line with, I think, most of the other ancillary companies in the auto sector, I think this company too has had a sharp fall in past. But I would think that given the kind of program that they implemented, including for the lithium ion, which you just mentioned, I would think that the company probably deserves to be once again back into the books and as far as the portfolios are concerned. So from that particular aspect, I think the stock, when we relook at it, I have not completely studied the entire result part at this point of time, but I believe that I think from whatever numbers that I have seen, I believe that the business of the company is bouncing back and bouncing back very strong. Not too surprisingly though, because both I think industrial sector as well as from the automobile sector, I think that the demand for batteries are also I think rising and rising sharply. So from that point of view, I would think that this particular company would be back into the books of some of the portfolios hereafter.
Devin, hi, good morning. Yesterday in the broader markets, it was all about earnings, right? I mean, so many earnings reactions. Even the disappointments were earnings-led. I mean, there was Voltas, there was Relaxo, and of course on the upside, all kinds of names, M&M Finance, PSU Banks. PSU Banks in particular, Devin, is there more to go here? We are speaking with the management of UCO Bank a little later. Bank of India reported earlier, good set of numbers. What's your sense?
Yeah, Prashant, good morning. Well, I think the PSU banks particularly, because they are available at a valuation at comparatively lower, there is a need to look at this particular segment once again afresh, particularly because of few reasons. On one side, whatever the first part of the provisioning was to happen has already happened, and I think most of the PSBs have already provided for those assets. On the contrary, with the improvement in the economic situation and the conditions, I believe that I think most of these banks are going to be recovering very, very systematically the amount that they have earlier provided in the previous years. Having seen recapitalization in some of the cases, I think the capital adequacy portion also is remaining, I think, equally strong for them to expand the loan book side. What one has seen is the corporate loan book which has started expanding, and I think that is what one has seen in most of the private sector banks, including in case of SBI within the public sector, or even Bank of Baroda. So from that perspective too, I believe that I think the loan book expansion would possibly result into better amount of business for most of the PSBs which up till now have been struggling, and particularly from the corporate side, both working capital as well as from term loan side. Seeing the liability side also, I think pretty systematically managed. I would think that the re-rating on most of the PSBs should be seen going forward in coming future.
All right, Deven, this quarter, that's the one that just went by, quarter two, it's normally weak for cement, and this time it was weaker because input costs were higher, prices didn't go up as much. But some of those companies, they miss estimates big time, namely ACC and Ambuja Cements. But a couple of these last companies that came out, Dalmia Bharat, the numbers were in line. JK Lakshmi Cement, actually those numbers are quite good. What would you like from the cement space, given that the second half of the year could be much better?
So you are right. I think second half of the financial year, I think definitely remains better year for cement offtake demand, including for, I think, constructions, infrastructure projects. So all in all, I think the demand scenario remains quite convincing, quite upbeat. At the same time, I think whatever the worst that one had to factor in as far as the cost hike is concerned, I think has been factored in already. I would believe that the coming period, this month and the quarter, we will be seeing improvement into the cement prices as well, along with, I think, the offtake. So on one side, the scale would help these companies to result into better amount of profitability. On the other side, some of the price improvement should result into improvement in better amount of profitability. And all in all put together, given the kind of fact that the cost is remaining under control now, possibility of, I think, we see the margin pressure up till now, which affected the margins of the companies in cement sector. Probably, I think that would not be the case hereafter in subsequent quarters. So, yes, I think the strong demand scenario and comparatively better management of cost hereafter would result into better profits for cement companies. So, second half definitely remains, I think, better prospect, and would consider the larger players like Ultratech, would consider larger players like Shree Cement, even for that matter in Southern Pocket, Ramco, or for that matter ACC Ambuja combined. I think they are probably deserving to be looked at again, given the size of the volume that they can produce and sell with the profits that would follow thereafter.
All right, let's do one thing. Let's take a quick commercial break. Stay on, Devin, we'll come back to you in a bit. When we come back from the break, we'll of course talk about all the technicals of the market. Mitesh Thakkar and Shrikant Chauhan will be joining in to give you some trades for the day. Stay tuned. Welcome back. Well, for now, the SGX Nifty is very, very quiet. So let's get Mitesh Thakkar and Shrikant Chauhan to tell us how to approach the day. Gentlemen, morning to both of you. Mitesh, by and large, this has been such a resilient market. 18,100 is holding. Your thoughts for today, how to approach it ahead of the weekend and the big macro and micro data that's coming through?
Good morning, Sonia. I think, yes, two important things which you highlighted. One, it's a very resilient market. I think, very clearly. While the fact is that we are seeing good fall happening in international indices, I think our markets have, respected the first support levels around the 17,900 mark. So I think broadly this market looks like a market which has run up from 17,000 to about 18,100 is now getting into consolidation. So there's no weakness, but yes, there is mild supply pressure, profit booking at higher levels. I think this scenario might continue for next few days. The idea in this case should be to buy near the support levels or closer to declines towards the lower end of the range, which is at about 7950, 900 zones, and try to take profits, be slightly nimble over there once we get closer to about levels of 18,200. I think eventually we will break above this level, and once that happens, then I think the Nifty could re-attend the all-time highs beyond 18,005.
Shrikant, what about you? How are you placed in terms of the view and trade?
Good morning, Prashant. Good morning, Sonia. I think still the markets are very clearly in the range. They are not breaking the upward barrier, which is around 18,200. And on the dismissal of that, we can expect 18,300, 400 sort of levels. On the downside, certainly there is a lot of buying interest, and number of heavyweight stocks are rebounding whenever the markets are falling to the levels of 17,900 or 18,000. So broadly, we are of the view that the markets are still in the mood of buying on dips. And we should be buyer in those companies which are very close to their important support areas or maybe very close to their breakout level. Reliance Industries is very close to its breakout level, and there we are expecting some upward activity in today's date. So we are expecting Reliance to move towards the levels of at least 2650, 2640. We can keep stop loss around 2520, 2510. And the other stock which we like is from the pharma sector. So Prashant, we like Dr. Reddy, which is around 4,600. There we are expecting 47, 47.50 sort of levels, and we can keep stop loss somewhere close to 4540.
Okay, all right. Thanks for that, Shrikant. Well, Mitesh, what about you? What are the stocks you're looking at?
Morning, Nigel. I'm going with an all buy list. I also have a pharma name in my choice of stocks. Divi's is the one which is featured over here. Buy with the stop at 37.30 for a target of 38.80. That apart, Piramal Enterprises had some kind of a big breakout yesterday. That's a buy with a stop at 8.80 for the first target of 9.30. Dalmia Bharat Cements is a buy. Keep a stop below 16.35. Look for targets of 1700. And there's some kind of a bigger rally developing on the charts of MGL. That's a trading buy for the time being for a target of 910 and a stop place below 875. But I think this is a stock which can possibly even try and scale 950 levels.
All right, Shrikant and Mitesh, thank you very much. Speak to you soon. Again, Manoj Muralidharan of Religare Broking is joining us with some F&O sort of ideas and perspective. Manoj, first a quick view. Does the market consolidate or can it keep running higher even as the rest of the world is slowing? Or actually going the other direction, and what would you want to put on as trades now?
Good morning, Prashant. Prashant, the cues are very objective because if you see the last month, FIRs are hardly 18 to 20% of long position in September and in October, sorry. And now we are in November, we have a good 60 to 65% long position. Needless to say, you're seeing 3 days of good buying in the cash market. The quantum has reduced a little, but yes, around 1800 to 2000 odd crores. And historically, if you see every time, the banks help in the rally, that rally sustains and we usually make a new high. So yesterday, if you remember, intraday also, after 18,000 was taken as a support, we saw the bank nifty also help inch the nifty up. So I believe today might be a day for the banking stocks and the metal stocks, and the nifty can inch more towards an 18,300 and beyond. So a better strategy here is you buy the bank nifty for this target somewhere close to 41,400. The stop loss should be 41,000. And to answer your query, yes, we might go to 42,300. So that's a target that we have in the banking stock in the bank nifty. For the nifty, we believe whenever the FIs have such a setup and we start a new series, it usually becomes a positive 5 to 6% series. So at least an 18,500 to 600 might not be ruled out with 18,000 as a base. We expect the positional target for this November series would be towards an 18,500. Now, as I said, metals, so I believe VDL would be a good stock to go long in today. Use an option trade, go with a 305 strike, you get it for 9 rupees. The target can be an optimistic 18 rupees, the stop loss should be close to 5 rupees. And SBI is a good buy at 584 with a stop loss of 575 and a 602 as a target.
All right, that's on SBI. Ahead of the earnings, that's interesting. The numbers come out tomorrow, so ahead of that, there's some calls coming in. Thanks, Manoj, for giving us all of those ideas. That's Religare giving us their views. Devin Choksi is still with us. Devin, I wanted your thoughts on SBI because the numbers are coming out tomorrow. And this is not going to be such a great quarter. At least the street is anticipating a slow NII growth, although the margins can improve. But overall for the industry, right? I mean, PSU banks have come back in a big way. The stock is at a 52-week high going into the results. Even if there is a slight disappointment, would you use it as an opportunity to buy into SBI?
In fact, Sonia, I would think that the numbers could possibly be, I think, much on the stronger side for SBI, largely because of few reasons. One, on one side, I think the corporate loan book has been expanding. And this is true for most of the larger banks, and SBI is not, I think, exceptional out of it. I think they are equally, I think, covered in that part. The working capital as well as term loan side of the business, I think, has been expanding at the rate of around 15-16% in many of the cases. So from that point of view, I think the size of SBI could possibly, I think, surprise us on the better side of the business. The other part of the activity, the retail credit growth has remained systematically on a stronger wicket, I think, as far as I think the business of the most of the lenders are concerned. And I think, again, SBI would probably have relatively better times. Given the fact that the liability side is well managed by most of these banks, and given the fact that I think in the rising interest rate scenario, they have relatively better opportunity to make margins, I would think that I think the profitability also would remain relatively on a stronger side. So Overall, I think I don't know completely whether I think we are fully justified to look at the businesses on a quarter-to-quarter basis. But overall, I think in this second half of the financial year, we are likely to see much sharper growth in the lending businesses, and particularly the larger banks would be benefited out of it.
All right, Deven, I wanted to ask you about some of these electrical consumer durables companies. Voltas was a disappointment; they lost some market share out there. Orient Electric, far smaller out there, but the numbers look very, very disappointing. I'm looking at a sharp margin compression as well out there. Any view on this space, the electric consumer durables companies?
Well, I think different views. Voltas, of course, I think they had to write off in that particular project overseas, and that's the reason for which the loss that they have incurred, apart from some amount of loss in the market share, which I believe they have the potential to bounce back. Look at the Blue Star's result. I think they are basically more convincing. So if you look at the domestic players and within that some of the larger ones, I think likes of Blue Star could possibly be suggesting that the business is intact and could possibly grow faster in the second half. Of course, I think in this particular line of activity too, on a quarter-over-quarter basis, I think the business could be disappointing also at the same time, because I think if the June-ended quarter had the influence of summers, definitely in the September-ended quarter, I think that influence is not seen. But going forward, once again, January to March quarter and March to April to June quarter, once again, I think you should be seeing higher amount of growth coming in. So from my way of looking at this particular business, yes, the business remains absolutely on a stronger wicket, given the kind of a growth that we are seeing in our economy. Also being endorsed by most of the retail lenders who are basically systematically lending higher to this particular segment of white goods and consumer electronics. So from that point of view too, I believe that I think these companies would probably directly show better performance. One of could be, I think, the situation in some of the cases in the last quarter result I would like to do.
Okay, all right. Deven, we'll take a very quick break here. Let's just, if we can put up the Asian market pack briefly, and then I'll take that break. The entire China theme is continuing to do well. We pointed out how Hang Seng is doing, but even onshore markets, the Hang Seng index is up 4.6, so it's turning out to be a solid week. But Shanghai Composite, the Shenzhen, those markets are also up 1.5%. The rumors of China reopening were quashed officially by Chinese officials, but the market is not taking note. So maybe we should keep an eye on what may come out of there. It's a market where, beyond a point, it's difficult to tell, which direction things are going to take. But prices are telling us something else, and that may be significant, especially for commodities, etc. We'll take a very quick break here. We are back with the pre-opening levels. Also, we have the management of UCO Bank. That's another PSU bank which has reported a decent set. Used to be the most stressed PSU bank name. That conversation follows in just a bit.